Mortgage rates improved this week for the first time in 6 weeks. And no, the Fed didn't cut rates. So what happened? Let's break it down. Now, the biggest enemy of long-term investment is inflation. Because when an investor invests money for 7 to 10 years, they don't want inflation stealing all their gain. They want to know that they're getting paid back and it'll still be worth something. So this week, the bond market was basically asking one question. Is inflation getting better or is it getting worse? So first we have the jobs report, and that is where we're looking at what is going on with employment. The economy actually lost 23,000 jobs in July. Now, we don't want people losing their jobs, but from the bond market's perspective, an economy that's running too hot can create more inflation. Hence, if we had a really hot jobs number, that would be inflationary. And so a softer jobs report told investors maybe the economy isn't overheating. Then Wednesday, we got the CPI report. That's what consumers or you or I are paying for goods. This CPI report came in at 3.4%. It's still too high, but it is lower than last month, which means it's cooled. Then today, we got the PPI report, and this is basically what producers are paying to produce goods. And the market expected prices to rise 0.2%. Instead, we had zero rise at all. Prices were flat, means they didn't change month over month. So when we put all three reports together, jobs are not running too hot, which is great. AI could be contributing to that as well because AI could be deflationary, what we're thinking. Consumer inflation cooled and producer inflation came in better than expected. So that takes some inflation pressure off the bond market. Remember, that's the enemy of any long-term bond. And that's important because mortgage rates are much more closely connected to the bond market than they are to the Fed funds rate. The Fed funds rate is a short-term investment. And so today, the average 30-year mortgage rate came in the lowest it's come in the last 6 weeks. And so here's what I'm watching for next. Not just whether the Fed cuts rates in September. I'm watching the 10-year Treasury, the mortgage-backed securities, and especially the spread or the difference between the two of them. Because if inflation continues cooling, and that spread starts moving back towards historical norms, mortgage rates can improve without the Fed ever cutting the Fed funds rate.